So what caused stocks to turn around today, and is Europe's debt crisis finally contained, or is it even over? Let's ask Charles Ortel, Managing Director of Newport Value Partners. Charles Ortel used to manage a fund that invested in Ireland, and he now says that Europe should have allowed the country to default. Also with us, we have Stephen Wood. He helps manage, just $140 billion as chief market strategist at Russell Investments. He's been cautiously optimistic about the economy lately. Good to have you with us, gentlemen. So, Stephen, I like that idea. You're cautiously optimistic. Boy, yeah, that sounds like a pretty hedged position right now. What do you make of what has transpired over the weekend with Ireland, with the bailout coming from the European Union as well as the IMF? Does this mean that investors can breathe a sigh of relief?
Well, investors can never breathe a sigh of relief. That's why you have to do this professionally and you have to do this well. Discipline is called for, but if you look at what's happening in Ireland, is a contagion contained, and we'll probably talk about this. It's almost like an NFL or an NBA coach. When there are rumors of them going someplace else, it's usually true. And I think the contagion effects can be very similar to that as we go into Portugal and into Spain. But I think a lot of what got masked by the Korean news, it got masked by the Irish news, is that the economic data in the United States came in a little bit better than okay. You know, GDP got revised from 2 to 2.5%. Consumer unemployment, wages was a little bit less bad, or maybe even a little bit better than a lot of people have been forecasting, which was lost in the noise. Not to say that it's great, but it was a little bit better. So I think that's got to be part of the investment data that you take with you going into 2011. So
good news from the United States, but not so good news overseas. So just let me get this. So your idea about contagion, does this mean we now start to worry about Spain, or we don't worry about Spain?
No, we do worry about Spain.
Okay,
we do worry about Portugal and Spain. So the club bed countries plus Ireland, they're going to be problematic. Europe has a lot of wood to chop, a lot of structural issues. They've been doing the European thing where they decide not to decide for about 11 years now, and the market is really forcing the hand of Europe to make some very immediate decisions, and I don't think they're quite there yet.
Charles Ortel, what do you think? I mean, do you agree with what Stephen is describing?
I actually think the situation in Ireland and Europe, and actually in the United States, is much worse than people appreciate. I think we have structural issues that have been papered over by various politicians and different parties in different countries. The simple fact is that the labor force, the imbalance between the supply of labor in countries like India and China and the demand for labor has basically fundamentally been put out of balance since 1989, 1991. To cover up the problems, what we've been doing in the advanced economies is borrowing more money than we really can afford to service, and we've been able to get away with it because nominal interest rates have trended downwards. We entered financial purgatory, in our view, in 2008, and politicians in the U.S. and Europe tried extraordinary measures to put everything back on course. But our take on the data that we look at hard is that we haven't turned the corner in the United States. Private sector, dependable, recurring incomes are simply not growing the way we like to see them growing. Yet debt is spiraling out of control, and contingent liabilities are spiraling out of control. To go back to Ireland, Ireland's basic problem is there are only 2 million people in the workforce, and they've attracted a lot of capital into that country, promising a low corporate income tax rate. So a lot of big multinational companies have put their profits over there. But they've also spiraled a lot of debt into the country, and there's no way you could make a workforce of 2 million people service the debts that have been built up there. So our view, sadly, is the right thing to do is to do what the Scandinavian countries did in 1991. Have an effective or a real default. Get this behind you and move on.
Can you have a real default if you all share the same currency?
I think so. I mean, I think Ireland's got to be asking itself, does it make sense today to remain part of the euro? I know technically, legally, it's not so easy to exit, but I think we're in a zone where the rules and laws don't really matter. I think we're going to reconfigure Europe, and I would lead that process as opposed to being the tail when there are much larger dogs out there like Spain and Portugal that are going to add to the mix.
Stephen Wood, what about this idea of Ireland either leaving the euro or, in a sense, maybe having a euro for domestic consumption and an external euro?
Sounds like China, you know, renminbi yuan, so you've got external and internal. Well, when when the Irish government vouchsafed all the deposits back in 2008, that really changed the rules of the game. So it's not just a private bondholder or equity-like default. So the government really is on the hook, and that triggers a lot of treaties. But I think also Germany, if you talk about China, Germany right now, I mean, they're able to export intra-Europe. So Germany likes having the euro the way it is because they get to export to a lot of their partners who can still buy a lot. You know, the drachma or the punt or the escudo would have dropped precipitously had this been 15 years ago to readjust. But I think that's The Europeans are probably going to have a long fuse on this one, like they typically do, so which means that this situation is going to be with us for a good long time, which benefits, in my opinion, the United States. The dollar is going to be more safe haven. Corporate America, you were talking about the consumer side and private investment, but corporate profitability in America is still extremely strong. Margins are fat. So I think when companies sitting on this much cash and this profitable, it's kind of the tale of a couple cities here. Corporate America, great. The economy, not bad.
Gentlemen, I put it to you that what's going on right now in Ireland and other parts of Europe is an anomaly, because we were just talking during the break. You have a situation where you have a contraction in economic growth. The economies of certain countries are actually getting smaller, yet the actual value of the currency is either staying the same or is increasing versus, let's say, the U.S. dollar, albeit with some slight dislocations this week with the U.S. dollar and the euro. But how does this, in a historical perspective, how does this play out? Because if your currency remains strong, yet your economic performance weakens, you then don't have any demand for the currency, which then fuels this increase in the value of the currency, much as we've seen with the Japanese yen. There's no reason people are buying the yen because of great economic power. They buy it because, well, there's just a lot less of it, and the demand for it remains constant. So if the supply dwindles, demand is constant, value goes up. Am I all crazy here?
You're not crazy. I think, Pam, what people are missing is that there are really two important elements. There's the wealth of a country, and most European countries, because they've been in existence longer, have massive wealth in relation to their
embedded massive wealth, right? I mean, wealth that we don't even know about.
Right, and maybe in the country in question, or maybe in Switzerland or elsewhere, but they have a massive amount of wealth, and GDP is a smaller piece of the puzzle. So you've got to ask yourself as a policymaker, do you want policies that promote wealth and protect the value of your wealth, or do you want policies that promote the growth in a figure like GDP, which we believe has many, many flaws?
Can you not have both?
Well, you can, but under this set of circumstances, the unstated and massive problem in the room is the demographic nightmare in winter in Europe and in Japan, where we have a complete mismatch. We have too many people age 65 and up, not enough people aged 15 to 64, and
you don't have enough people working to support the people not working.
Which is different than the United States, because we have luxuries that they don't have in Europe. Because if you look at what Europe's trying to do, they've got a currency they need to rescue. So we've already decided these issues a century ago in the United States. So I think we've got more policy flexibility than they would have in Europe in order to stimulate aggregate demand. And we don't want to get into quantitative easing in this environment, I'm sure. But if you look at in Europe, they can either devalue, they can default, both of which are off the table. So they
can't do it because the French and the Germans say there's no way this is going to happen.
So then they need to restructure their economy, which means they need to shrink wages and they need to become competitive. And you and I, last time we spoke, I saw the Prime Minister of Greece, and decisions that you made in March or April of this year, I mean, those have 5, 7, 10-year lifespans before you're going to see any benefits from that. So, I mean, it's going to be a long haul until you get the average Greek or the average Portuguese person competitive with somebody in Turkey or in India.
All right, you go ahead, because I'm going to give Stephen this time. I want him to think about what should investors do. You give us your perspective.
I think a further thing to think about here is that unlike the United States, unlike Europe, the United States has a massive commitment to maintaining the peace around the world, massive investment in the military, and as we learned over the weekend, we have new threats and new theaters constantly. So Europe has been able to do what it's done.
The umbrella of American protection.
From 1945 forward, without having to spend, and Japan, without having to spend.
And Korea.
And Korea, what really needs to get spent here going forward. So I am one of the people who does not believe that the mandarins in Brussels and elsewhere are going to have the time to come up with a plan now, while they also have to grapple with the various problems in Korea, in China, in the Middle East, etc. So I'm not so sure I agree with you at all that they're going to have the luxury to figure this out.
No, I agree. They won't have the luxury of figuring it out. There's going to be some very tough choices that are going to need to be made immediately, and the one policy solution is not there for the next 10 years. So,
so what do investors do, Stephen? I mean, we take all this into consideration, we put it all together in a package, and it's like, okay, now what do I do? What do I invest in?
Core Europe is doing extremely well. Look at those German GDP numbers. They've come a little bit closer to earth in the last quarter, but core Germany, core Europe is doing quite well. There's a lot of good companies in Europe, but the world's a large place. At corporate America, we've addressed emerging markets. markets, while they're getting a little pricey with kind of expensive currencies, there's still a lot of great stories there as well. So I think a globally diversified portfolio, commodity exposure.
Technology?
Technology, it can be.
Consumer discretionary?
Consumer discretionary, which is two sectors that we are overweight within our portfolio. The American consumer is doing okay. There's going to be a lot of growth in emerging markets. And if you look, for example, if you look at Brazil, is Brazil more of a Latin American economy or is it more of an Asian-oriented economy? Increasingly, it's exporting into Asia. So when you go global, and you do need to go global, you just need to understand how the pieces fit together, and it's not your father's global portfolio.
All right, I'm going to just steal the G from global, and I'm going to say for you, Charles Ortel, gold, right?
Gold, volatility, and short.
Gold, volatility, and short. That's all you need to know.
Exactly.
So you think that there's going to be a lot of back and forth in terms of asset price dislocation?
I think that what's going to happen now, since 1981, nominal interest rates in general have gone straight down. So that in that environment, if you're in the bottom of the capital structure, you're in equity, you're going to make money. We see the other direction happening from this point forward. We see country after country is going to have to demonstrate that they have their finances under control. Sheila Bair, who's not exactly, an Uber bear, said over the weekend that she believes that the United States could be the locus of the next central problem. So we see nominal interest rates going up. We think most equities are enormously overvalued. We think there's a tremendous margin of danger right now in most securities, and that's why we recommend gold. If you have the temperament to be short, short, and if you really have the temperament to watch screens 24/7 around the world, you play volatility.
Play volatility with the VIX index coming out of the Chicago Board Options Exchange. So, all right, take those 2 points together. Is there anything that could go right? I mean, we're talking about the U.S. economy, Stephen Wood, and surprising economic news out of the U.S. was pretty good. So is it possible that the U.S. becomes sort of the gold standard for investors that want to invest in the stock market?
So if I can agree and disagree just a little bit, but
I'm only going to give you 15 seconds, so go ahead.
Most people in America, they're baby boomers. They've been socializing this post-Volcker disinflation boom. Since 70, interest rates, inflation go down, asset prices go up. What we're looking at, I think, is a global portfolio, stock selection, research, homework. You got to know what you're doing. You can't just spread your crumbs upon the water.
That's why we got you both, and I appreciate you coming in. Stephen Wood, Charles Ortel.